Disclaimers. 1. The content shared in this podcast is strictly for informational purposes and should not be construed as financial or legal advice. 2. The opinions expressed by the hosts and guests are solely their own and do not represent the views of their employers or affiliated organizations. 3. None of the projects or companies discussed should be considered as endorsements or recommendations. 4. While efforts are made to ensure accuracy, the information provided may not always be up to date or entirely reliable. It is advisable to conduct independent research and seek professional guidance before making any financial or legal decisions. 5. The hosts and guests of this podcast shall not be held liable for any consequences or actions resulting from the use of the information provided. 6. All content, including text, graphics, and audio, is protected by copyright laws. Unauthorized reproduction or distribution is strictly prohibited. 7. Any discussions on sensitive topics aim to foster inclusivity and respectful dialogue, but differing opinions should be expected and not attributed to the podcast creators or sponsors. 8. By listening to this podcast, you acknowledge and agree to these disclaimers, and you are responsible for your own interpretation and application of the information presented.
Hey everyone, welcome to another episode of the Intersection4 podcast. Really excited to be here with Brendan, who you've seen in our previous podcast as well. Brendan is the founder of Athena Intelligence and our resident expert on everything technology, specifically machine learning and AI. Super excited to also introduce Fareed, who is, I would consider, a friend. And also an expert when it comes to corporate M&A and has a ton of experience on the bankruptcy and restructuring side. With everything happening around, and it really kind of started with COVID, but we're seeing just an increase in the activity on the M&A side. Obviously, there's an increase in the activity on the bankruptcy side of things. Me as an investor and Brendan as a founder have just an absolute ton of questions about how founders, investors, operators need to be thinking about restructuring, bankruptcy, M&A in today's world. And so we thought that Fareed could be a really good resource to come in and help us have this discussion together and make it more collaborative as a learning experiment. So I'll hand it off to Brendan to ask his first few questions, and then I'll jump in this one.
Yeah, thanks for joining us today, Fareed. Maybe for 2 seconds, want to pass it to you and just let you do a more in-depth introduction and just say hi.
Yeah, happy to. Well, thanks for introducing me. As you mentioned, my name is Fareed Kasani. I'm a corporate M&A attorney, and also, as was mentioned, I have significant Chapter 11 bankruptcy restructuring experience. I've represented all types of different parties in the bankruptcy process, whether it be companies in bankruptcy, secured lenders, unsecured creditors, bankruptcy trustees, creditor committees, equity stakeholders, asset purchasers, really the whole, gambit of, different types of players that'll end up, that you'll see in the bankruptcy process. And then as well as mentioned, I do probably the most of my practice is now doing corporate M&A, buying and selling businesses, whether it be for private equity funds, independent searchers, folks that have been, operating a business for a long time, looking to make an exit, really all types of different players in that M&A space. I work with a firm called Platt Richmond, which is based out of Dallas with offices in Houston as well. And so I have basically a team of other great attorneys that I work with that handle, areas from, fund, private equity, venture capital fund formation, tax, commercial real estate, intellectual property, employment, business litigation, intellectual property litigation, full suite of services.
Very exciting. Cool. Well, there's a lot we could go over. Maybe let's just start with a 30,000-foot view recap of COVID and its impact on your market, and maybe hindsight's 2020, how you've interpreted kind of the fallout from that period.
Yeah, what a weird curveball that was, because I think, when COVID hit all of us, we literally had no idea. We'd never experienced what this was, like going through, a global pandemic. Some days it looked like it was the end of the world. And then obviously it wasn't, but, I think there was, kind of a whole string of bankruptcy filings that kind of initially came, but then what followed with that was a lot of government stimulus money, which I think, probably saved off a lot of companies, that would have otherwise, gone into bankruptcy. And, in addition to both stimulus money, but also very low interest rates. And so, now we're at a point where, that money has, kind of started to dry up a little bit, and interest rates are higher. And so we're not seeing necessarily, a huge wave of bankruptcies, but certainly there has been an uptick in 2023, as opposed to, 2020. I think 2021, this is an insane stat. 2021 was the lowest number of Chapter 11 bankruptcies in 40 years. So think about how many companies we have in existence today, or 2021, as opposed to 40 years ago. And it was still and the total number of filings was at its lowest level in 2021. That just kind of gives you some perspective on just how high we were riding with all the cash, all the low interest rates, and all that that was keeping us. Plus, with the bounce back of the consumer demand with travel, everyone started traveling in 2021 and spending and being out there. So that's obviously starting us a little bit. Sorry, go ahead.
Would you say then that COVID maybe was almost a wash from like an outcome perspective for your industry, and it was truly just the interest rates that were the indicator for this uptick, or did COVID have a material impact that you felt, or was it a wash?
I would say it was actually, this might be sound a little bit surprising, but I would say it was a kind of it negatively impacted the bankruptcy and restructuring. Again, the numbers, like really in the first, maybe a couple month or so of COVID, there was kind of an uptick, and then all of a sudden just completely went away. And I think there was like a brief period where,
Why would that be? Like, why would it go away in the first few months?
Well, I think, there was like, a couple of weeks where, there was some panic. I know there was a couple bigger filings that happened right, at the start of the COVID. I'm talking March 2020-ish. So kind of in the retail space, which some of those, and I think some of those were looking at restructuring anyway. I'm thinking of Belk, top of mind. And there was one other, or at least a couple of big box retailers that, went through right at that point. Closed a bunch of locations Tuesday morning, others, but I think then, it was quick that, the money started to come in, the government money, and, all that I think that quickly stopped it. And I think it went through a really dry period for restructuring. And then I think after, like a few months into COVID, M&A started to pick up again. And there was a big rush of it. And I think that lasted really up until about last fall, so we're talking, in the middle of 2020 through about, second half of 2022, where, there's a big wave. And I think the M&A started to slow down. And I guess it's interesting because I kind of get to see both the M&A side and the bankruptcy side. I think the M&A side and the bankruptcy side, I think everything kind of slowed down the second half of last year. And I think both are picking up. Both M&A is picking up, and the bankruptcy filings are picking up. So kind of an interesting and hot time.
Yeah, very interesting that sometimes they go in opposite directions, and sometimes they're going in the same direction. And I think if I have to put on the investor hat, I think it has to do with, obviously it has to do with harder factors like interest rates, amount of financing available, the terms, stuff like that. But I think there's also softer factors where people feel like there has been enough time passed, or there's enough clarity on what the future looks like. And every time there's clarity on what the future looks like, you'll start seeing some of these decisions being made. Both even when a company is filing for bankruptcy, I think just having clarity on what the future looks like helps you also make that decision, right? Like, hey, right. I actually think the world has settled down, and I don't think we're going to make it, and so we should file bankruptcy. Or I think the world has settled down, and this is a perfect time to, do a transaction. But I think when there's uncertainty, essentially everybody is just in a wait and see kind of approach. And you can even convince yourself as, leader of a company that, if things became normal, if we just stick around long enough, like we can solve these problems. Right. But when I think things are quieter, you're able to get more certainty and a grip around the facts, and be able to move with more confidence, I think.
Yeah, I think that's exactly right. I follow, the Fed meetings pretty closely, and I think, just in the major, news headlines, and I think we have that now. I think we know that interest rates are probably going to be high, and they're going to probably stay high for a while. Which, if you're a borrower with a significant amount of debt that's looking to mature soon or soonish, and you're just not going to be able to make it happen with current rates and where your business is currently looking or and where it's headed, then it's like we got to pull the trigger. We've got to cram down and eliminate some debt, or we got to work out some financial restructuring. Same time on the M&A side, I think people know it's like, okay, well, this is kind of the top of the interest rates, and it's probably going to stay at this for a while. So how much longer are we just going to sit on whatever dry powder we've been sitting on now for a year? I mean, it costs money for us to sit on this, too. And, investors want to see capital deployed. And so I think, kind of knowing the rates are going to be here for a couple of years, let's still go out there and find some deals that, and I think,
I think everybody can convince themselves. So the companies that aren't performing well, they have some hope at some part, back of their mind that, oh, this is temporary. They're going to start cutting rates. But when they watch for 6 months straight or 9 months straight, they just keep hiking rates. That hope goes away, right?
Yeah.
And then for the people who are sitting on the capital, they start seeing what we see from an investor perspective is that it takes some time for the private markets, particularly, to reset in the founder's mind, like what a fair price looks like. And they're also in denial for the first 6 months, right? When you go to them and you say, hey, like you're not worth even 50% of what you think you're worth, they're in denial because just last year somebody sent them a term sheet at that valuation, right? But then they also have that little bit of hope that things are going to turn around really quickly and we're going to get back to the term sheet I got 2 years ago. But then when that drags on for a good 12 months, it resets in their mind. Okay, yeah, no, this is the new reality, and then there's more deals to be done because people are now all resetting and coming to the new normal, and more deals can be closed that way.
I think you've got two types of people in this world. There's there's opposite ends of the spectrum. You've got the entrepreneurs, startup founders who just have eternal optimism. And then you've got bankruptcy attorneys on the other side, who have seen just the worst of the worst, or I should say bankruptcy attorneys and lenders who, just have to be the most, pessimistic people. And I think, most people are probably somewhere in the middle, but that's probably the two ends of the spectrum, and I think, entrepreneurs, you have to be, otherwise, you have to be, to have that mindset going in.
Yeah, and I agree. And I think even within investors, like the debt investors on one side and the equity investors on, the other side of the spectrum, the equity investors have to be optimistic, right? Otherwise, they should never invest equity in a business. And the debt investors don't get paid for any optimism, right? Like they only get paid for being the downside protection. And so they used to teach us this during our work and in school, that it sounds like it's similar. It sounds like they're just different strategies, but you have to put on a completely different hat when you go from investing in debt to equity, because it's the ultimate difference between the optimism and the pessimism, and you have to really change your hat to appreciate the differences.
Sure.
Can you stepping to a previous bit you said earlier had me thinking, what about the M&A market being anti-correlated with the restructuring and bankruptcy? What is the fundamental thesis there, or what's the theory for why that is and when that breaks down?
I think and I think some of it just has to, a lot of it ties back to the macroeconomic factors. And I think both the corporate M&A side and both commercial real estate, large scale projects, whether it be, big shopping centers, utility projects, real estate, data centers, all that kind of, lumped in. I think, again, when interest rates are low and, money is cheap, it's easy to start new ventures and, start new projects and developments. At the same time, if you're an operating business, and you're in a situation where you've got either higher interest rates or you've got debt maturing soon, it's easier to refinance that debt when interest rates are lower. And again, and I think, as we know, Hamisa, I think you have the finance background. I have a little bit, but when interest rates go down, asset values go up, right? Because there's more demand, with cheaper money to buy assets, right? So I think it all kind of relates to each other, and of course, there's always. I'm sorry.
No, go on.
And of course, with bankruptcy, there's always external factors. That sometimes it's not all purely macroeconomics. Certainly, with some of the bankruptcies we see, it's there was some type of mass tort, a plant explosion, the J&J Johnson & Johnson bankruptcy with the talc powder that causes cancer, and there's fraud and Ponzi schemes, Bernie Madoff, which is not really sometimes it plays a factor. I mean, FTX, I think we've got some familiarity here with FTX. I think part of that just fell apart because of we learned after the fact that there were some bad things going on, but some of that you could argue was tied to interest rates started going up. People started pulling money out. There was a run on the bank, but then of course it exposed. When the tide comes in, and you kind of get to see all the stuff that's been going on. Sometimes there's some fraud, mismanagement, gross mismanagement, oftentimes, and then unfortunately these things are seen in the bankruptcy process, and there's litigation that comes from it.
Yeah, one of the things that I want to get both of your perspectives on, as founder that might be looking for financing, and then obviously a legal expert that's looking at these days all the time. I've been having some really interesting conversations with international investors who are just operating from a completely different interest rate environment. There are still parts of the world where interest rates are very low. And that's because their economies have been shrinking over the last couple of years instead of speeding up too much. And so they're starting to feel that there's a lot of opportunity in the US because their traditional competitors in these deals are no longer able to pay those prices and no longer able to justify those valuations. But just because they come from a completely different, interest rate environment, their capital is still cheaper. And because the capital is cheaper, they can close these deals, pay more, and still actually get the rate of return that they're looking for. And so, as a founder looking for capital, the possibility of looking for capital, and then somebody who puts these deals together on a regular basis, like, is there an opportunity for U.S. founders and private equity buyers and sellers to get financing from other parts of the world? It just feels like there's two different worlds sometimes when I talk to these people.
Yeah, I'll give my 2 cents. Personally, at the pre-Series A sort of fundraising, there's definitely enough capital in the U.S. So I'm not worried there. And I actually have a graph pulled up, and I'll show this one because I thought it was quite interesting. This is Carta, which we use for. Can you guys see the screen?
It is loading.
I think something's loading.
Okay, when it loads, I'll talk through it. So if this is it says pre-seed stays resilient, and it's effectively just a graph from Q1 2021 through Q2 2023, and pre-seed's the only one that's actually in the positive at a 39% lift from 2021. Seed, Series A, B, C, D, and E are all down. So definitely from my perspective, there's enough to stay here. The only other data
But
point
I'll explain why that's happening, though. I think there's some other factors in play. So when you think about it from the investor's perspective, one of the arguments is that the pre-seed companies are the furthest away from M&A and IPO activity. And so they're the least affected by the market conditions today. So what has happened is a lot of the larger players that had started actually playing in the much later stages are all going into the earlier stages, because if they want to finance, let's say they want to finance a Series D investment, that has to be something where there's a clear path to an exit or a public offering in the next 2 years to 5 years, right? they're not so certain that in the next 2 to 5 years, this whole mess is going to get figured out. But when you're backing a pre-seed founder, right, you're like, oh, it's like 10 years down the road, right? Like when we need to monetize this investment. And so your investment committee can give you the thumbs up on something like that. So what has actually, I feel, from the discussions I have, what's actually happening is a lot of the late stage investors, those behemoth, like large funds, they're not able to deploy capital. They're not able to get approval from the investment committees to deploy capital late stage. So they're all cramming the capital into pre-seed, like earlier stage companies, and that's actually helping keep the valuations like quite consistent and constant. And another way to think about it is, a $10 million valuation in 10 years is going to look like a joke, right? Like it's going to be that's just how inflation works, right? So in 10 years, you're going to be like, oh yeah, it's easy to get a $50 million valuation for a pre-seed company because just how capital grows. And so I think there's some of that in play as well, which is harder for people to appreciate and understand unless they can sit in the shoes of one of the
Yeah.
late stage investors and how tough it is for them to push through a late stage deal through investment committee.
No, that's 100% what's happening, and we're seeing the benefits of it and the fruits of that labor. So that's why we wouldn't consider anything abroad anytime soon. We've even had investors reach back out who previously said something like, we don't do pre-seeds, we do post-revenue. We need to see this metric hit, this metric. They're now relaxing a lot of their pre-seed stipulations. They're raising the bar in many ways too, right? Because there's a lot more competition in capital, but at the same time they're relaxing, going upstream in terms of metrics that they typically
And
invest
you might be talking from a place of, you're an AI founder at the pre-seed, right? Like this is like you have the luxury to talk like that, right? Like most people don't
in. Yeah,
in this world. And it just the fact of the matter is there are not enough AI companies, period, to absorb all the interest and capital that's out there. They just aren't. And so if you find a credible founder like you with a credible background team like that, that's you're already in the top, quartile of companies. But on top of that, you're in a world where there is a ton more interest and a ton more capital chasing. It's probably not even like physically possible to start that many AI companies to meet all this demand, right? Because you're probably talking about billions of dollars waiting to invest in this theme, and there's just no way you can absorb that, especially at the early stages, which is where most of the companies are today. Right
right.
now, in a couple of years, when they've grown themselves into Series D and E companies, yeah, you can absorb capital, but at this point, it's just so hard to absorb that kind of capital.
Well, how do you explain that Carta data? That do you think a lot of that is just AI companies, or do you? What I think, if I had to guess, is a lot of startups that are technology focused, focused on integrating, whatever resources they have, are doing the smart thing, which is integrating AI resources. Ones that are already built, like the Chat GPTs, but also probably trying to build off of that, and then have the ability then to go say that they're an AI company, which is not false.
There's actually a number of factors that help pre-seed companies. So this is one of the things that I try to make sure our investment committee doesn't do. What happens is you get scrutinized way more when you have metrics that you're able to scrutinize than when you have no metrics at all. And so you look at a company, they're asking for, let's say, a 2 on 20. So they're raising $2 million at a $20 million valuation. Pre-seed, great founder, great everything, zero metrics. There's like nothing to study other than the team's experience. People will not blink an eye and invest in that, right? But 6 months down the road, now they have 100,000 of revenue. Okay. Now the same company comes back and will be like, whoa, 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 whoa. I'm not paying 20 times revenue for this company. And I'm like, you were paying infinite times revenue 6 months ago with no problem. But now that you start seeing some of the metrics that you can benchmark against, people start scrutinizing the deals way more. And so this happens. It's very common. I've seen it in my own investment committee. But these pre-seed companies, you can sell the story, you can sell the big vision, and you can get financed. But you're not at the stage at that point where your metrics are going to get scrutinized and really benchmarked with anything else. But once you start getting into the later stages, now there's a benchmark for everything, for your user retention, for your user growth, for your revenue. There's a benchmark for everything. And so you start getting scrutinized a lot more, and people start thinking more from a private equity kind of standpoint, where they're like, okay, I'm paying 5 times earnings for this company over here, and I'm paying 4 times earnings here, so this is a better deal. And so I think that also plays a part in how these deals are scrutinized, and also how these deals are structured, because in those early stages you can get away with the safe and the convertible financing, and so you don't have to get stuck on the valuation and all those terms. But as soon as you get past that point and you do your first price round, now everything matters, right? And you actually have to come to terms, and so all the metrics matter and everything matters. So it's supposed to be easy to raise money at the pre-seed level, because you want the founders to just be focused on the big picture, the vision, and the product. And it gets, I think, increasingly harder and more concrete of a process as you get later into this stage. And so in an environment where everybody's paying attention to every deal, the more concrete process gets more scrutinized than the less concrete process, which is, I know the founder, I like them, they went to Harvard, here's a $20 million valuation. Yeah.
Yeah, that sounds about right. There's a lot more to diligence, after that initial investment.
From your side, is there any like stories that remember, like best story of either a bankruptcy as like the not so great end, and then maybe like a great M&A story where you worked directly with the founder who 15, 10, 8 years earlier was founding it, and they're giving you advice of like, oh my gosh, I wish I would have done this, or thank God I did this. Any that come to mind?
Not quite
They're all pushed out. They're all pushed out by then.
Yeah, I mean, I've got I'm an advisor to a company, and it's been it launched kind of before COVID, and that really slowed down. It was an out of home advertising business related to the rideshare space, and I think unfortunately COVID really hit pause on it. And so, but there was a second round of funding that came in within over the summer. That has kind of reignited, the business, and so I'm hoping that in a couple of years it'll be, it'll be a great story to tell about, how the waves that came through, and then a nice exit to go with it.
Yeah, I think the way to describe like all of what happened over the last 3 or 4 years, like one of the ways like to describe it is that it's all mean reversion. But like when you get that far off, when the government steps in and does that much, it always comes back to whatever the mean was supposed to be. So that's what all of this feels like. The companies that were supposed to go under are going to go under over the next couple of years. All we did was kind of just confuse everybody and push it into the future. I don't think we fundamentally solve the problem for many of these businesses. Like if they're poorly run businesses, they're poorly run businesses. And one of the things that maybe we should do with the podcast, and it would be great to have you on for that, Fareed, is I've always wanted to interview founders of companies that have failed recently, and talk to them about what happened, and not what happened, sorry, but what they learned from the experience. Because I think too many people focus on the founders that have made it, and of course there's like tons of learnings there, but I think the introspection and the level of depth that you can get out of somebody who's just failed a company, just went bankrupt, just been removed as CEO, like I think it can be really, the learnings can be very deep there. So I'd love to get some of those people on and just learn from their experience. So maybe somebody doesn't have to learn it the hard way and can go through an easier path there.
I would imagine a lot of the people that have had success though have probably had prior businesses though that have gone under? Because like, I mean, to me, it's mind-boggling to imagine that someone first company hits unicorn status, makes an exit out the door, 30 years old, they're billionaire. That's probably rare. I'm sure it takes 4 or 5,
Yeah,
sometimes,
almost
different
never, right?
ventures,
Like
side hustles, or
I don't
whatever it
think
may
I've,
be to
I've
kind of
really ever
to
seen
find a
that
happy
situation
place
happen,
and to get to an
and
exit.
that's also one of the reasons that even today in this market, if you are a second-time founder or a third-time founder, like you will get financed, like at whatever terms, whatever you want, you will get financed at those terms. So it's almost never, I've never seen, at least from my purview, first time founder like really do it. Um, now what I mean by first time founder isn't necessarily like a venture backed company. Like even if somebody's run a lemonade stand, that gives them some level of insight, maturity, and like how to deal with a lot of these things with a certain level of maturity. But yeah, it's almost always something like that. You can see the early signs of entrepreneurship and the early signs of like that grit and drive in most of these very successful founders. And I say it all the time, like the most successful people in the world have more failures than the people that we consider least successful, right? Like like if you think about Elon Musk and some of these people, they've had incredible failures, which is and their ability to get through them is why they do what they do. So a lot of people think that the people we consider the most successful have always had just success, but they probably have 10, 20 times more failure than the regular founder out there.
And
But
they're not immune from future failures either, as we know,
absolutely.
which happens too.
Yeah, yeah, we were talking about threads and Twitter, um, on the last podcast. So I'd love to get your thoughts on that, right? Because that is a huge M&A transaction. It seems already that it was totally overpaid for the transaction. Like, any thoughts on, how something like that might play out when they're losing customers, they're losing advertisers, users left and right, and Elon Musk can't get away from his, style of trying to fight this guy and trying to, fight that guy. Like, how do you think that plays out?
Is that for me?
Yeah.
I'll be honest. I guess I've been following the Twitter, transaction, kind of at a high level in the news.
Okay.
But what I can gather, it seems like it's not going well. It seems like he built one of the world's most successful companies, ever. I think it hit like $1 trillion market cap at one point.
Hmm.
And then Twitter. I don't know. It seems like he's going to lose a sizable chunk of his investment. Um, I don't know.
Yeah.
It doesn't seem like things are really going well there.
And he
I
put
don't know what.
up Tesla stock as collateral, and there's a ton of debt on the Twitter deal. That's the collateral is Tesla stock,
Yeah.
and they I think believe I think they paid 40 billion. Estimates are it's not even worth 10 at this point,
Mhm.
because left and right they're losing advertisers. Advertising revenue apparently is down 60-70%. And that all of that was before this whole Threads thing by Facebook. So Threads launched a direct competitor, right, to Twitter, and obviously built off of the Facebook platform. So they got hundreds of millions of users very quickly. So there's, yeah, but like the only thing that stops me from saying like, yeah, this is going to be bankruptcy is a lot of Elon's companies have come to this point at the brink of bankruptcy, and then somehow he figures out how to make it work. So that's the only thing. I don't know if you guys really buy into that, but every time people have doubted him for any of his crazy ideas, he's actually been able to figure it out.
Just interesting investment thesis, right?
No,
I've
I'm not going to invest in that thesis. I'm just saying, like, I'm going to put a caveat in there that, yeah, I think it's the company's in trouble, but Tesla, SpaceX, yeah, you name it, like all these companies were at the brink of bankruptcy.
Well,
And
maybe Twitter will build a direct competitor to Instagram and Facebook. I mean, just like full scale war. It's all they're all competing for eyeballs. I feel like, and I don't have a TikTok account, but I feel like that's really who's getting the most traction right now
yeah,
is TikTok, and I think as people just like the videos and stuff. I guess I think that's really just what's popular.
the short form video, and it's also like a primary platform. So one of the things that I don't enjoy about going on Instagram and Facebook is that you're just looking at the same stuff from the same people, right? And when you want to like kind of explore and you want to kind of go learn something, you're not going to learn that from, the 100 college friends that you have on Instagram. You're going to learn that on a platform like TikTok, where yeah, you'll have some friend content, but you're going to really be on a primary platform where you're like exploring new content. And I think that's actually a small difference, but a really large difference
Yeah.
between many of these platforms is they can actually be very different in their experience because you're not just in this small bubble, you're like in a really large bubble that keeps actually changing to fit what you like.
One thought I just had on the Elon Musk thing around this idea of like, do you invest in him around Twitter? I think the answer is yes, because he operates as a bank at this point. I think in the early stages, like he truly would have gone under, like as a personal account, so many times. But he has accumulated so much wealth, he could probably find a way to weather most storm, and like that probably is what like separates him. He can get through periods and droughts and take big
Mm,
bets. That's why Google and Facebook and Amazon are all crushing it. They've had periods of poor performance, but their bank statements and their accounts allow them to just keep making big bets, and no one else can compete in that realm.
mm,
I think that's why you say yes to him, not because of the bet he's making on Twitter, but because his 8 other bets are all going to diversify his ability to
mm,
just keep it alive long enough to figure it out.
mm.
I think Tesla will continue to thrive. I got a feeling that Twitter. I don't think it's going to go bankrupt, but if I had to guess, he'll probably get tired of this and sell it, and probably take a loss and move on. That would be my guess.
Yeah. Yeah, but it's cross collateralized, right? And so if it
Yeah,
didn't have debt on it, absolutely 100% agree, Brendan. Like the guy could put in $1 billion a year for the next 500 years and have no problem, right? Like he could run the company, but when it has that much debt on it, that's where you now have to answer to creditors. Like you don't,
yeah.
you don't just keep running it.
Check this out though. Like what I mean by like he's able to cross pollinate, we'll call it, his companies. So the one thesis that's sprouting up in the AI community is that part of the reason he bought Twitter was for the chat log of all of history, and he turned off the ability to scrape that. Right, so no one else gets access to it. He has like a long accord of high quality, intelligent individuals having conversation, being able to then kick that off to his AI company and have the AI company train the data. He has the Tesla supercomputer dojo to use to train the models and to operate large amounts of like energy storage. So he's basically has 3 companies right there that are all like highly leveraged on the other one's ability to bring something of value.
Aren't they going to all come under X though? Isn't that what the plan would be? To like his X company is going to basically everything will fall under one. Like
I don't know. I mean, that's what he did
I've
with
heard
Solar,
that theory. I don't know if it's
right? Like he
Yeah,
bought.
but taking one of these public companies like Tesla, into another is just the transaction is just too large, right? Like we're
yeah. I
talking
don't
about, yeah, those
think
transactions, like we're coming to the point, like it's obviously acquirable at this point. Most of these companies are like nobody could acquire them.
Hey, I'm gonna have to leave you guys at this. I got 2%, and I got 2 minutes left as
Sure.
well.
No,
For
let's wrap it up. Then let's wrap it up. Obviously, like super interesting discussion, and I learned every time. Obviously, when I spend time with Brendan, I learned something new. But obviously, because of my professional relationship with Fareed, I learned a ton from him as well. I'm glad we could all get together. I think that was an interesting conversation from the perspective of both the founders and the investors that are looking at this market and trying to make decisions.
yeah,
So thank you guys for making the time, and we'll see everybody in the next episode.
thanks again, Fareed. This has been awesome, man.
Yeah,
Yeah,
thank you. Thank you for having me. I enjoyed the conversation.
Of course.
Appreciate it.
Thanks, Fareed.
Good
See you
day.
guys.